Stop right there. Do not look away from your screen. Because what you are about to understand is not a normal chart movement. It is a warning, it is evidence, and it is a story Wall Street never wants the average American investor to fully grasp. Right now, on the silver chart in front of you, do not look at the price itself. Look at that single vertical line shooting straight upward. That violent spike that seems out of place. That line is not just a technical anomaly. That line is a digital explosion, a moment when the market accidentally revealed its true nature. In a matter of seconds, silver launched from the high 70s straight past $83, as if gravity had been briefly turned off, and then, just as brutally, it was slammed back down into the mid-70s, a nearly $9 swing inside a single trading session. If you are new to investing, your stomach probably dropped. You probably thought the rally was over, that the bubble had popped, that you just witnessed the end of the bull market. But if you lived through 2008, if you remember 2011, if you have seen how markets behave under stress, you know this was not fear. This was an operation. This was not organic selling. This was a deliberate stop hunt, an algorithmic ambush designed for one purpose only: to remove leveraged retail traders from the system. The banks understood exactly what week this was. Ghost week. Low volume. Thin liquidity. Empty order books. And when a market becomes thin, even a small push can create violent moves. They allowed the price to run intentionally, not because demand suddenly exploded, but because they wanted to manufacture FOMO. They wanted traders chasing Sunday night gaps, piling in with leverage, convinced they were about to get rich overnight. And the moment that trap was full, the door was slammed shut. That is why this move is not just a drop, it is a rug pull. But the story does not end there, because the real question is not why silver fell, but what that fall actually means. On the daily chart, the candle forming is known as a shooting star, a small body with a long upper wick. In technical terms, it represents rejection. Price attempted to go higher and was pushed back. But rejection does not mean collapse. It means pause. It means the market needs to breathe. When you strip away the noise and focus on the closing price, the truth becomes impossible to ignore. Last week, silver closed near $71. After all the chaos, after the spike and crash, we are still trading around 78. That means the volatility was violent, but the trend remains intact. The easy money phase is over. Now begins the phase where only strong hands survive. Look at gold. Gold is sitting calmly above $4,500. No panic, no spike, no collapse. That is stability. That is the anchor. And as long as gold holds, the floor beneath silver is not disappearing. Silver is simply the high beta sibling. It overshoots on the way up and overshoots on the way down. The traders who panicked at 74 were not wrong emotionally. They were wrong structurally. They were over-leveraged. Physical holders did not panic. They looked at the screen, shrugged, and went back to their lives, because an ounce is still an ounce. Now look at where the market actually bounced. $75. That was last week's breakout level. Old resistance becoming new support. That is textbook behavior. That is where the industrial whales were waiting. Samsung, Tesla, the solar giants. They did not chase 83. They waited. And when the banks smashed the price, they stepped in and bought cheap contracts. Smart money buys weakness. Crowds buy strength. And today, once again, wealth was transferred from emotional hands to disciplined ones. But the most important part of this story is not what happened on the chart. It is what happened everywhere else. While the paper market was collapsing from 83 down to 74, ask yourself one simple question. What was happening at coin shops across America? Did dealers suddenly slash prices? Did they rush to change their boards and say, "Spot crashed, silver is cheap now"? Absolutely not. In most cases, premiums stayed exactly where they were, and in some cases, they even increased. This is the real metal did not move. There were no lines of people dumping bars, no panic selling, no trucks leaving vaults loaded with silver. What moved was paper, contracts, code, algorithms. That is why anyone waiting for a physical dip likely missed it. The window was open for minutes, not hours, and even then, many dealer websites were already showing out of stock. This proves the drop was a paper event, not a physical one. Now look at the industrial side. Imagine you are a procurement manager for a major solar company. You saw silver hit 83 in the morning and your heart skipped. Then you saw 74 and you celebrated, because you just locked in cheaper supply before year end. That is why the bounce from 74 to 78 was so aggressive. Industry absorbed the selling. Paper weakness turned into physical demand. That is a healthy market. The floor is rising. Last week it was 65. This week it is 74. We are building stairs, not cliffs. Volatility is a tax on leverage. Futures and options traders paid that tax today. Physical holders paid nothing. In fact, they gained information. They saw a glimpse of the future. 83 was not fantasy. It was a preview of what happens when suppression briefly fails, like forcing a beach ball underwater. The grip slips for a second, and it explodes upward. Then it is forced back down. But now everyone knows how much energy is stored. Look at currencies. The dollar was flat. This was not macro. This was not rates. This was internal market structure cleansing excess positions before January. If silver had run straight to 100, the eventual crash would have been catastrophic. This reset made the market stronger. Now consider the algorithms. A shooting star scares humans. Machines see volatility. They step back. They reduce exposure. That creates chop, 75 to 80. Boring. Frustrating. Deadly for options traders. Exactly the environment institutions love. Pension funds do not care about daily candles. They care about monthly closes. And if silver closes the month above 75, it will be the highest monthly close in history. That single candle outweighs all intraday violence. Banks can create noise, but time creates truth. Miners see this too. When markets become casinos, producers stop hedging. They hold supply. That removes metal from the system when banks need it most. Today, banks bought from forced sellers. Tomorrow, they may find no sellers at all. That is how squeezes are born. The lesson is simple. Do not confuse intraday chaos with long-term direction. A month ago, 78 sounded insane. Today, people are disappointed it is not 90. That mindset shift defines